Are you worried about how the Fed's rate hike will impact your finances? Do you want to know how to protect yourself from inflation and higher interest rates? If so, then this video is for you. In this video, I'm going to explain what happened at the Fed's meeting on Wednesday, what it means for inflation and interest rates, and how it will affect different sectors of the economy and individual consumers like you. I'll also give you some tips on how to cope with these changes and take advantage of new opportunities. The Federal Reserve is the central bank of the United States. It has a dual mandate: to keep inflation low and stable, and to promote maximum employment and economic growth. To do this, it uses various tools, such as setting the federal funds rate, which is the interest rate that banks charge each other for overnight loans. The Fed has been raising its key interest rate since 2018 to fight inflation and keep the economy from overheating. But this also means that borrowing money becomes more expensive for consumers and businesses alike. And with the recent collapse of Silicon Valley Bank, one of the largest banks in the country, many people are wondering how this will affect their savings, investments, loans, and mortgages. Inflation is the general increase in prices over time. It reduces your purchasing power and erodes your savings. The Fed aims to keep inflation at around 2% per year as measured by the Consumer Price Index. However, inflation has been rising faster than expected in recent months due to various factors such as supply chain disruptions, labor shortages, and higher demand for goods and services as the economy reopens after the pandemic. The Fed expects inflation to be transitory, meaning that it will subside once these factors fade away. But some economists worry that inflation could become persistent and require more aggressive action from the Fed. Interest rates are the cost of borrowing money. They affect everything from credit cards, to car loans, to mortgages, to student loans. They also affect your returns on savings accounts, bonds, and other fixed income investments. When the Fed raises its key interest rate, it makes borrowing more expensive and saving more attractive. This can slow down economic activity and reduce inflationary pressures, but it can also hurt borrowers who have variable rate debt or need to refinance their fixed rate debt. The Fed's rate hike affects different sectors of the economy differently depending on their sensitivity to interest rates. Some sectors benefit from higher interest rates, while others suffer. For example, banks benefit from higher interest rates because they can charge more for loans while paying less for deposits. This increases their profit margins and stock prices. Utilities suffer from higher interest rates because they have high debt levels and low growth prospects. This makes them less attractive to investors who seek higher returns elsewhere. Technology companies are mixed because they have low debt levels but high growth expectations. Higher interest rates can make their future earnings look less valuable when discounted back to today's dollars. The Fed's rate hike affects individual consumers in various ways depending on their financial situation and goals. Some consumers benefit from higher interest rates, while others suffer. For example, savers benefit from higher interest rates because they can earn more interest on their savings accounts and bonds. This can help them reach their financial goals faster and protect their purchasing power from inflation. Borrowers suffer from higher interest rates because they have to pay more interest on their credit cards, car loans, mortgages, and student loans. This can reduce their disposable income and make it harder to repay their debt. Investors are mixed because higher interest rates can have positive or negative effects on different types of investments. For example, stocks can benefit from a stronger economy and higher corporate earnings, but they can also suffer from lower valuations and higher volatility. Bonds can suffer from lower prices and higher yields, but they can also benefit from lower inflation and higher income. The Fed's rate hike may seem scary, but it doesn't have to be. There are some things you can do to cope with these changes and take advantage of new opportunities. Here are some tips. Review your budget and debt. Higher interest rates mean higher monthly payments for variable rate debt and higher costs for refinancing fixed rate debt. You may want to review your budget and see if you can cut down on unnecessary expenses or increase your income. You may also want to pay off your high interest debt as soon as possible or consolidate it into a lower interest loan. Adjust your savings and investment strategy. Higher interest rates mean higher returns for savers and bond investors, but also higher risks for stock investors. You may want to adjust your savings and investment strategy according to your risk tolerance and time horizon. You may also want to diversify your portfolio across different asset classes and sectors that perform well in different interest rate environments. Seek professional advice. If you're unsure about how the Fed's rate hike will affect your personal finances, you may want to seek professional advice from a financial planner or advisor. They can help you create a customized plan that suits your needs and goals. The Fed's rate hike is a big deal that will have significant implications for the economy and inflation, interest rates, different sectors of the economy, and individual consumers like you. But it doesn't have to be a bad thing if you know how to cope with these changes and take advantage of new opportunities. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more videos like this.